All right. Well, good afternoon, investors. Welcome to yes, it's a bear market. What are we going to do now? What do we think now? Session of Bull Sessions. My name is Mark Robertson, and I'm joined here by my dear colleague. And in times like this, you got to have magnificent, magical mathematicians on your roster. So we do with Ken Kavula. Good afternoon, Ken.
Good afternoon, everybody. Mark, this reminds me of the sessions that we had when we were planning for our very first Burke back in the early part of this new century. And we chose for our theme Dancing with the Bull. I'm sorry, right. I'm sorry, I'm misquoting myself. Dancing with the Bear. So maybe we need to get a dancing bear on the front of our slide in the next couple of weeks here if this continues.
Well, somebody did ask me where we are on the slide, and I would just explain that you and I went looking for those penguins on that island in the Indian Ocean. So
I was a raft.
Yeah, I was trying to get permission from Ken to put penguins on the slide, and he just said no more animals. So these are things that happen. We are joined here in the back room by Matt Spielman of Houston. Good afternoon, Matt.
Good afternoon, Mark. Good afternoon, everyone.
Now, are you doing a Houston Cougars victory dance this morning or this afternoon?
I think they can hold their hands high. It's a series of unfortunate events at the end, and it's always disappointing. But I liked as we talked about some coaches earlier before the start of the program. As hard driving as Houston's coach is, I thought he gave a really good post-game interview, and his talk about what he said in the locker room was really great too. So they'll be back.
They had a heck of a run, and I don't know if Kim is back with us yet, but Kim Butcher is joining us from Florida, and she actually she's doing the other version of the victory dance for sure.
The other version? I'm doing the stay inside. It is pouring rain here, and the lightning is. Well, it is an entertaining show.
Oh, there you go.
Well, we would never comment that you deserve it down there, Kim. So we'll just be very quiet about the weather. That's all. We have snow predicted for this afternoon here. So.
All right. So
I'm having good vibes, and you're having not so good vibes.
We're getting it all. We're getting every form of weather known to Michigan here over the last 10 days. So we're cranking away here. All right, we're going to cover just basically two things here this afternoon. Three things. We'll talk a little bit about the market, but we are going to take a look at the Buttonwood demonstration portfolio, and we'll talk a little bit, introducing a subject about just taking a step back and looking at some cash flow stuff. So with that, let's go ahead and get underway, unless you've got anything else, sir.
No, I think it's time to look at our Portillo slide.
Send me your penguin images. Here's our
Is that a true headline, or did you make that one up, Mark? Is that one true?
I did not insert that one. That one was written by somebody other than me.
Oh dear.
And this is our weekly reminder that they're not a sponsor of the session, although they should be. And I didn't have lunch yet today, so that image is making me very hungry. But this is an actual article from just a few days ago. I don't believe it was in any way connected to April 1st. But
you hope.
You never know.
I wish it kind of was,
But we have gone all the way from 16-ish back to 10-ish, so you know how that feels. And I'm going to get off the subject before Kevin Gologly lectures me on it.
You're not doubling down on it right now, Mark?
I am not doubling down. In all seriousness, if you do a stock study of the company, they do have growth prospects. Things are going well. Things are okay, but I do have a slight concern that if they expand too rapidly and get themselves in a little bit of debt, that could be. We'll just see. Let's hope that they prudently continue to expand the business geographically. We'll leave it at that. Uh-oh, somebody's ringing.
That was me. I'm sorry.
That's all right. Here is our standard disclaimer. Extra important today. No investment recommendation is intended. This is entirely about education and the display and the interpretation and the illustration of the methods, techniques, and philosophies of the modern investment club movement. made famous by the National Association of Investors, also known as Better Investing, and as interpreted by us here at Manifest Investing. What we are simply seeking to do is share the wonderful lessons we have witnessed, observed, and practiced for the last several decades. So you're going to hear our opinions. Please, please, please underline it, bold it, do your own homework before making any investment decision. If we hold something in our personal portfolios, we will attempt to remember to disclose that, but it is up to you. Make your own decisions about all of this stuff. If you would like copies of today's slides, or if you have follow-up questions or suggestions for topics, I do have a roll call of questions for next week, Ken. Send us an email at either of our 2 email addresses at the bottom of the page. Okay? Moving on. A summary of what's going on in the market. First of all, upper left, the market has probably increased consumption of the visual on the upper left, and that's okay if that helps you. The market's gone crazy. I mean, just the other day it went up. My active portfolio went up 10% in 45 minutes. I don't consider that normal market action. It's been that kind of crazy. Even today, I think the market was up 5 or 6%. And last I checked, it was headed back to 0 or worse. Don't anybody tell me we don't want to be depressed, but that is the market that we live in these days. We are going to talk about Buttonwood here for a few minutes, and the Masters is underway down in Georgia. And of course, that quote is one that we have used a number of times from Wall Street Week, the public broadcasting show from the late 1980s, early 1990s with Louis Rukeyser. And this was one of my favorites, many people's all-time favorites. This was after the worst day in the stock market, I believe, in stock market history, October 1987 at the time. And let me emphasize the last thing you said. Let me say, ouch. We're not pretending that a down market doesn't come with some pain, but we do want to remind as we proceed here today that it also underscores opportunity. What are your thoughts, Ken?
I agree with everything that's said by Mr. Rukeyser, and I agree with the fact that there is opportunity out there. I would just counsel a little bit of patience, and I don't want anybody to be fearful, but I don't think now is the time for really aggressive behavior either.
In other words, a balanced strategic approach. Is there any tequila up there on the upper left? I don't know if there is.
I think that might be tequila in the far right there. I'm not sure.
Right. Okay. It's there. Here is your reminder going back 20 years, looking at the value line arithmetic index. We don't want to pretend for a minute that this type of thing doesn't happen from time to time. I would say at least every 10 years, maybe even 7 years, but you have moments like this. And you can obviously see the 2008-2009 situation, which actually began on Halloween 2007, by the way. And a couple other little blips along the way. Of course, the 2020 was COVID. And we're in a moment again now. And I heard a statistic the other day. I'm not 100% sure this is accurate, but somebody asked Grok what to think about this situation. And here's the quiz. How many times has the market lost over 20 or 25% in the last 75 years, Ken? Any thoughts? How many times?
15 times.
Okay, that's pretty close. So we'll give it to you. The answer is 20.
Okay.
How many times did it fail to return to those previous levels?
0.
0. Yep. So yeah, the amount of time for that recovery was dependent on the severity of the cause. If you go back and look at it, obviously the Great Depression had its moments. The one that is cited as most persistent and troublesome for the extended period is the oil embargo of the 1970s, which I barely remember because I was tooling around in a 1974 Chevy Nova and I didn't care that I could only buy gas every other day. You know, but that was a moment. But,
I'm just getting a picture of the wind blowing through your hair in a Chevy Nova here, Mark. Okay.
with an 8-track player, Ken.
Yes, I mean, yeah, probably.
Yeah, an 8-track player. All right, so this slide is just a reminder that these things happen. This slide was actually provided by Marie Frank, and it's just a fairly vivid demonstration of where most people are. If you're feeling any concern over the situation, or if you have family members, and I had a number of discussions with family members this past weekend, and they were probably over in that far slot on the left. It is a time when you want to take a step back and do that measured balance thinking that Ken just mentioned. I also find it kind of interesting, Ken, that the artist on the upper left got the colors backwards compared to the one on the right. So I think the extreme fear should be a green light, and the extreme green should be a red light. Green should, just thinking backward. Can I do that? I guess so. All right, pressing on. This is a couple other things that have been discussed. The one on the left is the American Association of Individual Investors Sentiment Index, and it's broken down by state. And what has been discussed fairly extensively is this has been kind of in the dumps for a little while now. If you look at this section right here, the sentiment has been negative for a little bit, going back at least several weeks, if not months. And a lot of people have been talking about that. And you can see that the bull-bear spread, more bears than bulls, have driven that down. And Ken, I think that map gives us the answer to how you would find a way to put yourself around optimistic people.
Yeah, we either move to Alaska or Mississippi, right?
I want to see what Louisiana is doing with no comment. They got something going on there. Them in West Virginia.
Well, what we need.
That's Matt. Do you think that's no comment, or I was just wondering that myself? Do you think that's no comment, or do you think that's pretty evenly split between bears and bulls?
Oh, either way, that might be good groups to surround yourself with when you're thinking about it.
Yeah, could very well be.
Yeah, because what is the dark spot in North Dakota?
I think that's the most pessimistic. That's the most bearish state in the union, I think, right now.
Okay, great. All right, and the slide on the right is a slide that we've talked about. You can actually go to Manifest Investing and do a site search for that ticker, and you can find more background on this. But literally what it is the number of new highs minus the number of new lows. And obviously there's a whole bunch of new lows going on right now. And just looking at it for relative magnitude of the situation, it's one of the moments. 2008, 2009 was really a bad one. COVID shows up, and although we are in the middle of the month, if we have any recovery between now and the end of the month, that will change the shape of that red spike of death on the far right. So, and I think that still could happen, especially as people make some of their tax-related investing, as they always do at this time of year. Any thoughts or questions, Ken?
No, these are pretty standard graphics, and they're kind of scary. It's as simple as that,
All right.
This one's a little scary too.
You know how we always talk about you have to squint to see the white space? Well, that's no longer true.
It's pretty clear now. Yeah.
There's definitely a gap between the line of reasonable expectations. And you can see that, again, in the context of long-term investing, I would say anytime you're between, roughly here and here, you're in kind of a fairly valued zone. So we're not very far to the top of that zone. 8 to 12% for a return forecast is probably fairly normal historically, as shown by the graphic. So we're still not in a tremendously oversold condition, at least not yet. So again, the return forecast on the average stock checking in at 10 to 12% right now. What are your thoughts?
I just want to remind folks that the light green bar is a work in progress. It won't be completed until the end of the quarter that we're in right now. Am I right, Mark?
That's correct. It goes
So
till
we have
June
all
30th.
the way till the end of June before that light green bar will actually finalize itself. So it has plenty of time to move up towards that blue line yet.
You know, we probably could get some type of a pool, like an over/under going on that, but based on my performance in the NCAA tournament, where I finished 2,100th place in my bracket, so you know, let's not do that.
Yeah,
All
we
right.
have enough contests already with the groundhog, Mark. Okay.
Oh, nice segue, Ken.
I
Way to
know.
go. All right, we're going to spend a moment talking about this one, and this is something that Buffett said, I don't know, 10 days, 2 weeks ago. If you sell based on price declines, you're doing it wrong. And that's true. So here, let's dive a little bit deeper into that. I went to Perplexity and I said, I want to know more about what Mr. Buffett is thinking. And again, he's talking about avoiding decisions based solely on stock price movements. You hear us talk about that all the time. And again, the key word is solely. You know, if you're selling just because the stock price has gone down, you could be setting yourself up for disappointment. So he's been critical of it. If you did it if you do it recklessly on a regular basis, it can lead to poor outcomes. And because it ignores, you know, thinking about the value. They talk about intrinsic value. I'm going to give you a different way to think of that before we're done here. Maybe defining it, because very few people have ever defined the intrinsic value, at least to my satisfaction. And this sounds an awful lot like us, I think, consistently advocating for focusing on the business, the fundamentals of the company, such as earnings potential, and there's that major word, quality, rather than short-term price fluctuations, which we again classify as opportunity, not risk. Anything else you'd like to emphasize there,
No,
Ken?
this is just I know that formulas intimidate some people, but these formulas that Mark has on the page here are just the normal how you go from one price to another price if you are growing by a certain percentage. And he's just putting it into symbols and then trying to explain the symbols to you. And I like to reassure the 2/3 of the audience that is getting a little bit of sweat on their forehead right now because there's a formula on the page, and I just need to reassure you that your computer can do this arithmetic, and this is just basically arithmetic. All you really want to focus on is that R, that growth rate. What do you think it's going to grow at? And once you can decide that, the computer can do all the figuring for you.
Absolutely. And if you can actually look up for a future value calculator on with the website, and many calculators handle it also. But here's basically digging in a little bit deeper. Again, Buffett says if you're selling just on the price declines, you're doing it wrong. So there's the formula: the current value times 1 plus the compound annual growth rate. And that caret means to the 5th power. Now, don't let that, again, intimidate you. You can do this calculation with a calculator, or there are websites that solely allow you to do that calculation.
See, that's the difference between the two of us, Mark. I have 35 years of teaching experience that says that 55% of the audience or more right now is shaking when you have that caret in there. So, okay.
That damn caret.
Yeah.
But anyhow, that is to the power of. So it means, for example, in the previous page, taking that 10%, adding it to 1, so you get 1.1, and then multiplying 1.1 times 1.1 times 1.1, doing that 5 times. So, and that's how you get to this 161 and this result down here. So that's all that to the power of, or that caret means. So yeah, I share the audience's heebie-jeebies over that type of stuff. Many of us were treated to a Greek formula in the news over the past week, so we're all just kind of decompressing from that too. All
Well,
right.
they aren't as all opaque as that formula from this weekend, Mark. So,
All right. So the compound annual growth rate, CAGR, that we use is, you know, for all the stuff that we do, is the overall portfolio weighted average projected return. That's the return forecast And what I'm pointing out here is that last week, that number was 14.5. So basically, at the time of last week's bull session, we had $3,700 in the Buttonwood portfolio projected to grow at 14.5% per year. And this is the calculation written out for you. And here's the result of the calculation. So the portfolio that we had intact just a week ago was basically $3,700 roughly projected to grow up to become, and again, this is 5 years from last week, $7,300. Is that clear enough, Ken?
And here's Mark, where we can talk a little bit of simple English. I know that all of you understand that in 5 years, if your money doubles, it's been growing at about 15%.
Mm-hmm.
And so if it's growing at 14.5%, it would do just a little bit less than doubling. And if you kind of double that 3,700 and get 7,400, you'll see that in fact the results did a little bit less than doubling. So Mark's formula is working. We should keep that in mind.
You always want to check Mark's formulas. There's no doubt about that. All right, so here's that situation. So we were using this 14.5% last week. We got this 73.05. Okay, what a difference a week can make. The Buttonwood balance with all that's been going on in the stock market. And by the way, we went down a whole lot less than the average stock or the average portfolio, but we dropped from that 37.12
37.12, yeah.
down to this over the course of 5 business days. All right. But when you take a look at the dashboard, you notice this. That 14.5 is now 16.1. That's without making a single change in the portfolio. It's simply because of the drop in the stock prices of the portfolio. Okay, so now you take the new numbers, these two numbers, 35.13, and multiply it by the new return forecast because of the price drops. Look what you get. And literally, we didn't lose 200. I mean, our balance declined $200, but overall, we actually gained 100 in expected value. And I think, I mean, pinch me, Ken, but I think this really demonstrates, whether we do it directly or indirectly, how we think about investing.
Now, we
Fair
should
enough?
be very fair, and we should be very fair, though, and mention that this is everything else staying exactly the same.
Mm-hmm.
If you're going to go in and redo all your stock selection guides and make extremely conservative calls based on 1 week's behavior in the stock market and turn all your returns from a possible 12, 13% to a possible 4, 5%, then none of this calculation is going to make any sense to you. But everything remaining the same in a 7-day period, then roughly we still have the same general value for the portfolio 5 years from now based on our judgments. I mean, we've talked about crayons before, we've talked about tolerances before, and I know that you're reading $95 difference, but to me those numbers are basically the same, and that's all that I'm taking away from this exercise, that since the numbers are basically the same, not much has changed in my portfolio except prices have fluctuated. That's all.
Yeah, and if you want to really get deep into the weeds, I'll go way out on a limb and say, with all of the talk about, I'm not even going to say the word, the T word, that's being talked about so much in the news, the ultimate impacts of that are so much smaller than anybody knows. It's ridiculous. And trust me, there's not a single journalist and not very many economists on the planet that have any idea, because this stuff has not even come close to where it's going to end up yet. And even when it does, it will not have the profound impacts that are being bandied about in the press. That's my opinion. I have dug in and tried to understand the numbers. I'm a pretty good mathematician. I think Ken might even admit that to you. Yeah, it's not going to be, the impact will not be nearly as big as as you think. Let's talk about a worst case
Well,
scenario. What
and
if
Mark, if you go on, finish up. I'm sorry.
just
Go on.
one clincher here? What if we embargoed China such that our trade with China went pretty close to zero? Well, it would be disruptive, true, but that's exactly the planet we lived on just a few years ago. We were not exchanging goods with China. So again, would it be the end of the world? No. Would it have some impact? Yes. Would it be monstrous impact? I doubt it. Go ahead,
I
Ken.
think the underlying idea that Mark is trying to get across and that I'm trying to get across is that we're long-term investors. And if you're trying to make sense out of what's happened in the market in the last 8 or 10 days, and if you're trying to explain tariffs to yourself or to your partner or to your club or to your family or whoever you're trying to explain it to, I think it's a fool's errand at the moment because nobody has any idea of what they're going to end up doing or being. There are as many theories as out there as there are people talking about it. And I think the best thing we can do is to continue to evaluate our companies for the long term and not try to factor in something that we have no concept of how it's going to impact the business of our company. I might be owning companies right now where tariffs are going to actually make them do better in the business world.
True.
And I might be impacting companies, those tariffs, where the company is going to be agile enough to avoid most of the decline, whatever it happens to be. And you know, I am so tired of hearing about the screws in the Apple's phone. I just don't think that's a major part of the price of an Apple machine. So until we can get some more data and until we can get some data that we can trust is going to stay consistent for a relatively long period of time, I think that we need to fall back to our original kind of dealing with stocks. The kind of analysis we do on a income statement makes sense. Mark's going to show you another tool to add to your toolbox in just a couple of moments here, and take that panic and put it behind you. I have been noticing a number of people starting to use the quote that originally came from Liz Ann Saunders about 2 weeks ago, and the quote was, "Panic is not a strategy."
Yeah.
So keep that in mind. Panic is not a strategy right now.
Yep, not even close. So what we're going to spend the rest of this session talking about is how do we make that number better? That's what a club meeting is all about. All right, but before we do that, you want to talk carnage, Ken?
Well,
right.
I'm still bound by a handshake, Mark, to report that my grandson is now in 3rd place in the contest, and Don Sheets, one of the partners in my club, is still in the top 10. So with that being said, I've done my due diligence. I've made the public statement. Oh no, I got to finish the statement. I'm not on the list yet. Okay.
Oh, okay.
And there we are.
Well, and we can report that Ty Hughes, Kevin Gologly, Murray Frank is hanging in there.
Matt Spielman is now on the top 40. Yes.
Kim is just off the list. That Breakfast Club over in Illinois is 13th this year. And I did go down one extra notch to catch Steve Emmerich. He's not able to be with us here this afternoon, but it's good to see Steve climbing out of the basement this year. Yeah, how nasty has it been over the last week or so? We went from -11 to -19.5, and only one individual or entity, Warren Buffett, has the only $1 million groundhog portfolio at this point. By the way, the image is from the Clue Train manifesto from a few years ago, and I think that's not a groundhog. I had to double check to make sure it wasn't a groundhog.
Just
All right.
roadkill, right? Okay.
All right.
I say, Mark, couldn't Warren's returns be just his cash portfolio? He's getting interest and beating everyone.
It is. He's got $300 billion in T-bills, so he's he's getting 4%. So yeah, I'm envious of that. I tried to get him to send me some money too, and he didn't return my call. Hate when that happens.
Yet.
There you go. Yet. Okay. All right. Just a reminder that when you see red ink, go shopping. Again, I'm not sure where that headline on the left came from, but I am 99% sure it's from one of the legacy media outlets because they use the word nightmare and terrifying, and that's how they apparently want us to be. Again, red ink. Anytime you see the CNBC Clarion up at the top, it's probably a good time to think about buying when. Again, as Ken said earlier, not recklessly, but strategically, and just keep doing what we're doing. And then on the lower right, I share this belief. It's not all about the tariffs. It actually might be something worse, but it's not all about the tariffs. And that's from somebody that's been doing this for a very long time, very, very successfully, Mr. Ray Dalio. All right, so let's go ahead and press on.
I have a sniff test, Mark,
Oh, no.
for the market right now. Okay.
Okay.
If the person that's talking to you doesn't understand that a point drop is different than a percentage drop in the market, then you need to just stop listening to them immediately. Okay.
Absolutely. In fact, I was looking at something this weekend where it became quite clear that they didn't understand what percentages were being tossed around with some of the trade negotiations, and they just didn't get it.
I'm just talking about the fact that people told me that it was the worst drop in the stock market ever, and they forgot that it was the worst point drop in the stock market ever.
Yeah.
It didn't even come close to dealing with the worst percentage drop in the stock market. It doesn't even make the top of the list or near the top of the list when you're talking about percentage drop.
Right. I don't remember the exact number, but I think it's 4 times less or 4 times smaller than that
prompted
that Louis Rukeyser quote from October 1987.
Yeah, from 87. Well,
the
market lost close to half its value because I was an investor during that time period. Yes, folks, I'm that old, okay?
All right, just a couple of things here. This is our list of the masters among the investing world. These are Rhino portfolios with one exception there at number 17. I put that one in there to make sure that Ken holds his head high, even though we have slipped below 5 on our relative return. There's only 10 here. That's out of 650 funds that are greater than 5, and that's where we're trying to be. But again, a little bit of context. Notice that this number, which used to be 11.5 or 12, the benchmark return on the last 10 years has now dropped down to 10.6. That's still not the end of the world. But we do use this list as a source of potential ideas.
And I know there's some of you that are moving to number 7 on the list and saying, well, hold it, that benchmark's different. And that benchmark is different because the performance since date is different. And that's because this is a relatively new fund compared to the other funds that we're listing on the list right now.
Yeah, so we basically like to go shopping for opportunities in places like this. We covered the Motley Fool last week, and they've actually moved up also here fairly recently. So that's where we get some of our ideas for stocks to study. I would also point out, just kind of tangentially, they're having trouble keeping their growth rates up also. Those numbers have ranged anywhere from 12 to 14, and you can see that they have eased off a little bit. That's just simply things slowing down in the windshield. Okay, here's a look at our performance perspectives. There is a notable achievement there, the Buttonwood Bulls portfolio, which we're going to talk about, and beating the market by 6.5, Ken. That was sudden.
Well,
I wasn't ready for that.
I wasn't either, and I'm not exactly pleased that we're beating the market when we're down 12.
Yeah,
but the market's down 18.5, and that's a good thing, folks. I don't know if you want to blow up balloons and whistle at everybody over something like this, but you shouldn't be beating yourself up when you can beat the benchmark by 6 points or so. You just shouldn't.
Well, and you did it. You didn't do it by opening some short positions or some counter market positions, right? It's the quality that means you didn't drop as far.
Exactly.
It works both ways.
Absolutely.
Yep, we'll see that. Our quality is extremely high, and just as we always advertise and counsel, quality protects you a little bit in times like this. But yeah, I'm not happy about -12, but I'm a lot happier about -12 than -30.
Well, even -18. So
And by the way, we did get as high as -8 this morning. So we'll look forward to the day when that actually nudges into the positive. Nothing else of real merit on here other than Ken dragged me over the coals and asked me about this number. I just simply forgot to switch it back. So, and if you're wondering about that, that's just Mark forgetting. All right. So let's talk Buttonwood a little bit. And this is basically what we want to try to kind of stick to on a monthly basis. We want to talk about, well, we've already done the education. That's Buffett's admonition about the stuff we just covered. But review the club performance, take a look at the portfolio, look at it from a couple different dimensions, challenge the companies that need to be discussed, nominate things to sell if appropriate. And most months that's going to be a no, but there will be times when we will. And purchase candidates, internal and external. And down at the lower right, I've basically laid out, we're starting this meeting at those three conditions, 15.7 return forecast with a quality of 93.9 and a growth forecast of 12.1. And after we go through that, that's where we're going to end up. And that's what you want to try to do. You want to go from here to there as best you can and do it methodically over time, over the years, over the decades. Keep it
and
there.
we're fully aware also that it's going to be more and more difficult to move these numbers in this kind of manner as the portfolio grows. Right now, it's a young portfolio with relatively small holdings, and the numbers will move fairly easily. We'd like to settle ourselves into a portfolio where like Mark said, we won't do very much selling, and most of our activity will be in adding to what we already own, occasionally selling something and maybe replacing it with another stock then. So don't look for dramatic changes like this on a regular basis, but in a small new portfolio, it can be done.
All right, so here's a quick look at performance, and we counsel that as an investment club or an individual investor that you become aware of what your performance is relative to a benchmark, like the total stock market here, the Wilshire 5000. I'm just showing you the nuts and bolts of the calculation. Since you guys all got the heebie-jeebies over the carrots, I'm not gonna go too crazy with this either, but basically it keeps track of all the money into the portfolio, and the current value is used to do your computer does all this for you. So does your club accounting software, generates the rate of return numbers that we use both for the Buttonwood portfolio itself and matching investments in the Wilshire 5000, which is what you see here. And we keep track of how well we do. What if we had just put that money into the Wilshire? We'd have 3,400 instead of 3,600. And that's basically keeping track of the performance. And again, we're not doing handstands over 12.1, but it's a heck of a lot better than -20. At least it feels better.
When I first read the chart, Mark, I kind of was asking myself, what the heck does correction mean? Why don't you explain what happened in March 2025 there with the two entries and the 1 mark correction?
All right. Well, my wife is, outside of having incredible taste in men, she has an incredible sense of what this is all about. And when she heard we're in a correction and her investment club experiences, well, why don't I throw some extra money at this? So she literally is throwing extra money in honor of the correction, and then extra money this month because we officially went into a bear market. And really, all she's doing is anytime the projected return gets higher, she gives more money. So that's going to be kind of interesting to watch. We might do some calculations with and without in the future. But the important thing is, and I've told this story before, but I'll tell it one more time, at least one more time. A money manager friend of mine back in Wheaton, Illinois, used to talk about how difficult it is to get investors, some of his clients, to control their emotions. And he would come into work, sit down at his desk, and a brick would come flying through the plate glass window. And he says, well, fine, that's obviously somebody's having trouble controlling their emotions. The next time you're tempted to do that as an investor, tie a couple of Benjamins around that brick when you throw it through my window. And that will actually serve you quite well. So again, this is the whole thing of when return forecasts go up, it's okay to increase your commitment. And that's all she's doing there. Thanks for the reminder,
Well,
Ken.
and I also think, Mark, that Wendy was smart enough to not tell you to sell everything when the correction began either, which was which I think was an instinct of a lot of folks when they had two really bad days in the market and then the weekend to think about it. I think a lot of instinct was to, well, let's get rid of most of the stocks we own. Let's go to cash. And I do think that the vast majority of people on television have served us well, at least in advising people not to run for the hills.
Yeah, she did catch me crying myself to sleep, and she did express some concern over my bracket selections for the NCAA tournament, and she hopes that they aren't anything like anyhow stock picks. All right, here's the portfolio. What are your thoughts, Ken?
Well, I think it's a pretty good, solid portfolio. I think that if I were faced with this portfolio in a club that I belong to, and if the club was a little bit anxious about doing anything at all except spending the money they had, I think I could probably go along with that. At the same time, I do think there's a couple of weak spots in the portfolio that we can look at. And where do you want to start? You want to start with possible sales, Mark? Is that where you want to begin?
Well, just a couple of reinforcements. Matt had already mentioned the overall quality of the portfolio is actually higher than I'm generally comfortable with, but it has certainly served us well. This 93.9 is pretty stellar quality, so that's there. We would like to get this number up a bit. So we want to find opportunities that will boost that overall return forecast, projected annual return. So I thought we would start with exactly your instincts on this, Ken. This is the worksheet from Manifest Investing. And all we're doing is highlighting, what gets our attention. We've sorted this by the return forecaster, the projected annual return. The highest return forecaster at the top, the lowest are at the bottom. This becomes kind of an automatic challenge. And even though it's 10, 10 is generally enough to keep it out of trouble, and the growth rate is double digits. But we just want to rake it over the coals and see how we feel about it. The only other thing that on this chart, Ken, as I remember our discussions, is that Gentex is one of the lower growing companies. We actually do have an alert on that if it sinks down to 10% or less on the return forecast, we will tiptoe away.
And the rest of that alert will be that we're going to be very carefully looking at its first quarter earnings as well. We're going to see if we see any signs of deterioration in the standards that we've set for the company. When you do an SSG, you set standards, and your immediate reaction should not be to change the standards. It should be to hold the company accountable to the standards you set. And if it's not meeting those standards, then you consider moving it out of the portfolio.
A month ago, we did have an extensive discussion on Gentex, so you can go back and check that if you would like. But Paycom basically ends up on the hot seat for this particular company now. And I mean, I'll give my observations first. I see a company that is slowing down. It's an excellent company. Don't take my remarks the wrong way. I mean, this is a high quality, excellent company, but it is slowing down. And if you look at the growth rates post-pandemic, basically drawing a line here, you could make a case for growth rates closer to 10% than the 14, 16, or 18% that you're seeing here. So you want to condition your expectations. Now, if you own this company and you're holding it, that could be an appropriate thing. If you have reason to believe that this is in some way going to, for good business reasons, continue, that would be part of your assessment of the company. But as for me, it is slowing down. It is in an interesting area. And the projected return is kind of mid-range, shown here. And what are your thoughts, Ken?
Well, I'm going to go back to rule number 1 from Mr. Nicholson in the investor handbooks from Better Investing. And I'm going to remind everybody that rule number 1 basically was you sell when you can make the portfolio better. And that doesn't mean that you can make your par move up on a particular stock by a point or two, because that's just in the tolerance range. Any of these tolerances, can move up 1 or 2 points without much price change at all. But if you can improve the stocks that you're looking at so that one has a par down in the 10% range somewhere and another has a par above 15% somewhere, then you might be making the portfolio better. Now, of course, it's all based on judgment. It's all something that you're not going to know how good your decision was until 4 or 5 years from now. But it is part of what you do when you're trying to put together a portfolio. I'm going to point to the price bars in the bottom of the 4 graphs there that you have, Mark. And I'm going to show that huge growth in price up to around 2020. Just by connecting the tops of those price bars. And then I'm going to show what's been happening since the pandemic. And the price bars basically, folks, have been moving in the kind of the opposite direction. That is a company that maybe got itself over its skis, we like to say, and maybe got way overvalued from where it should be. That also might be a company that's beginning to face more and more competition. I happen to own this stock in a club, but I also own Paychex in a club I belong to, and I own ADP in a portfolio that I manage. And I know that those 3 companies are locked in some really fierce competition, and there are other players that are entering this market, and this moat that used to be around these payroll processors is shrinking because of AI and because of the fact that keeping track of huge amounts of data is becoming easier and easier and easier. That shrinks the competitive moat and turns these services into commodities. Maybe this is a space that is going to have some serious problems, and there might not be room for as many payroll processors as there were 5 years ago in this space. The competition is fierce. I think you pulled this bull say, bear say from the Morningstar site, right, Mark?
That's correct.
Yep.
And for the audience out there, you out there in the audience, and me too, we want to join Ken as a 1%er, because then you just own an entire industry. You just don't own one of them. So you heard it here first. He owns ADP, Paychex, and Paycom. Clear evidence.
Just very small pieces of them, Mark.
All right, so I would concur with all of that. Again, I'm not making the decision solely on the price action there, but it does concern me. So it's not solely, and that's the important word. That's not the only thing at work here. As Ken said, I mean, back in this time frame, the PE did get a little bit steep. We saw that same type of historical activity from Paychex. So there's a few things at work here. The one thing that does give me a little bit of heartburn is when thinking about selling is the analysts are really optimistic about this company. That gets a big question mark. I mean, they think it's really undervalued. Profitability has been on the up, but if they do see some of that competitive pressure, that would be something I would watch as a shareholder. The Motley Fool has actually bought it 4 times in the past, so it is among their covered positions. So yeah, the decision could go either way, but I think we have an opportunity here to replace a 10% par with one slightly higher that can improve the overall portfolio. So rule number 1 applies. All right, anything else here, Ken?
No, I don't want to badmouth Paycom to the point where you automatically turn around and run out and sell it out of every portfolio that it exists in. I think that you have to have a strategy. If it's in a behind the tax screen, that needs to be part of your strategy. If it's on this side of the tax screen, then don't forget there's capital gains if you have a big gain in this company. And there's all kinds of considerations that go into selling something, especially something with a sales growth of 10 and a PAR of 10.
Yeah, and we bought it there, and we're selling it up here. So we actually are walking away with our largest capital gain in the portfolio to date. So you can see the average cost right here. So even though this is a young portfolio, it's kind of fun to have a capital gain of that magnitude at this point. So at this point, Ken was in a shopping mode or mood or both. And we had decided to go ahead and basically raise the positions. Again, the ones on the, this is sorted by the return forecast, this column right here. So the ones at the top are the ones where we would look to accumulate. The ones at the bottom are potential selling considerations. And Ken and I have agreed that we would increase to a full position. By the way, I see this portfolio possibly having as many as 20 stocks, so 10 would be full, 10% of total. These would be considered full positions. And we'll add some Novo and some Lulu. I personally bought Novo this morning, as I'm sure others in the audience may have.
And I told you all earlier that I have 8 stocks on a list of stocks that I want to add to, and Novo and Lulu are both on my list of 8 that I want to add to in my IRA, my own personal portfolio. So I'm in the process of pulling together some things. I'm just not quite ready to buy yet. I frankly don't think we've hit bottom yet.
Yep, could be. You could be right.
And that's just all there's. That, it smacks of market timing if you try to get too precise. So I'm not going to get really fancy with it, but I might give it another week or so yet to see what happens.
Can only climb into the bathtub one lug at a time. So
yeah.
All right. So I suspect that some of these companies, if we're going outside the portfolio, some of these probably end up on your list, Ken. The one that kind of jumps off the page at us here today, and I think for the reasons circled, you can see a lot of financial strength, stability, quality, and a sufficient return forecast for United Therapeutics, a company which Ken added to the roundtable this month's roundtable.
And so did you.
Oh yeah, that's right. I did second that decision. So
yeah, both of us added. We both came up with the same stock for that night. Yeah,
we're going to lose the audience if we can't come up with fresh material.
Right.
The ones on the left they're arrowed on the left are ones that are already in the portfolio. So this is where we would go shopping. So here's a quick look at United Therapeutics. We're not going to spend a lot of time on it.
Before you get off that slide, I'm going to make a real quick argument that I know somebody in one of my clubs would make if I were making this suggestion to my club. They would be pointing out that we already own Novo in the biotech industry. Do we really want another biotech stock? And my response to that was that the biotech industry is one of the largest industries in the Morningstar classification system. It's huge. And when we're looking at an established drug company, large, very large established drug company with a whole series, a whole stable of products, and then comparing it to a very small biotech company that's doing very, very experimental work in 3 or 4 different areas, I really think we're looking at 2 different enough companies within this umbrella industry that we don't have to worry about with them competing with each other.
Absolutely. I think it fits the characterization of 2 different companies within an industry.
Yep.
You want to try to, I'm not going to invest in
portfolios. It's not a Pepsi and a Coke, Mark.
Yeah.
Okay.
Yeah.
Yeah.
or a ADP and paychecks.
Exactly. Well,
You're
you
not
don't
going to live
fully
that one down.
control some of those portfolios. So.
Absolutely. All right, here's a quick look at the company. Again, if you want more detail on the company, you can listen to the roundtable from just a few days ago. But they're into some really interesting area to explore solutions. And I think we'll leave it at that. Running short on time, I will notice that very often when Ken expresses interest in a company, you will find that its return forecast is near a multi-year high with increasing, improving quality. It's usually and then of course the up, straight, and parallel at the bottom. It's pretty easy to see how they reeled him in. All right, good stuff. So we'll add that, and that basically spends all of our money and ends us up at 18.4 with a slightly improved growth rate. So we hope that this portfolio will serve us well going forward. There's a look at the new portfolio. You can find this and you can follow along and play along with us at the public link at the bottom of the page. So just for fun, yesterday that value was $7,410. By the actions taken today, we've actually bumped it up to here by improving this number. I think that's kind of a cool way to think about it. Any other thoughts, Ken?
I think that the graphics say it all, Mark.
All right, so let's go ahead and move on. I just want to introduce a topic. We're not going to spend a lot of time here other than to touch a few nerves perhaps and try to figure out what's going on here. This is Charlie, and basically presenting some companies that Charlie talked about quite a bit. And the comparison being made here, this was right off of X or Twitter, and it's by these guys, whoever these guys are. But what they've done is they've picked out a collection of 10 great examples of companies where their free cash flow per share, the compound annual growth rate, compares pretty favorably to their stock price total return or compound annual growth rate over, you can see, a fairly lengthy period of time. So the first example is Apple, and these two numbers are pretty close together. Here is Visa, again, matching up fairly closely, and Booking, again, fairly closely. The free cash flow growth versus the stock price total return, annualized total return. Here is Accenture. We have people amongst us that work with Accenture, again, matching up. And then Palo Alto, the cybersecurity company, I would draw your attention to. They are picking different time frames for obvious reasons. This company hasn't been around quite as long. Here is Adobe and United Health. And again, we say that stock price follows earnings. Well, it's also going to follow cash flow. I don't think that's a surprise. Here's Chipotle. Numbers matching up pretty well. But you're sensing a common theme here. Arista, same thing. And closing with Monster. And then the table to the right is how the 10 of them stack up. What's your first impression, Ken?
Well, that we might have another tool for our toolbox, Mark. We know that Value Line uses free cash flow to set the value line. Why not take a little bit more serious look at free cash flow, make sure that everybody understands what it is, and then begin to use it as another validator, verifier for our studies. We already have PE that we use. We've been using Prove now for a couple of years. There's nothing wrong with having a third tool.
Absolutely. So I think we will take a closer look. And here is just some fact checking on my part. Because they were using different time frames, I went back and limited all of them to a 10-year time frame, so I knew exactly what I was looking at. And I didn't do a point-to-point cash flow growth. I did a regression analysis, just like we would do for calculating the sales growth of a company. Basically, that graphic where we peel the slope or the growth rate off of that. So that's the same thing. And the annualized total return over that 10-year period. And there are a couple on here that Ken was having a bit of heartburn over. What were the two companies that were?
Well, my eye is drawn immediately to Apple and to Adobe. I mean, a 2-to-1 variance in these numbers in different directions makes me say I want to understand why. You know,
Mm-hmm.
why is this happening? And does this destroy the use of the tool? I don't think so. But I think a good answer to why they can vary as much as they obviously are varying between Apple and Adobe. I also said to myself, the variance in booking and in Monster is a little bit bigger than I would like to see, but I still think if I squint enough, I can make those two numbers come close to being the same thing in booking and Monster.
And we'll obviously take a look at a number of these. Ken and I had a discussion beforehand. Does this extend into younger companies earlier in their company life cycle? We need to look at that. I will also clarify that I did not use free cash flow. I used value line cash flow, and we'll make the distinction between the two at a future
Well,
session. But
this is a 10-year period too.
mhm.
We probably want to make some rules and regulations about when this is good, just like we do for earnings or for PEs or for anything. And you know, you're never going to get good trends out of 2 or 3 data points. So if the company only has 2 or 3 data points, you're probably on a fool's errand trying to use anything to do a good solid study of the company. But when you have a company with 7, 8, or 9, 10 or more years of cash flow data, maybe we have a great tool to use right here. I happen to think we probably do.
Yeah, and I think that as we go through it and look at it more carefully, if we see a strong correlation between these two, I mean, it definitely feeds into here. The numerator in that calculation is basically directly related to cash flow, and it'll only strengthen our understanding of the value of that and perhaps teach us a little bit more about that. All right, so we will come back and look at that more closely. Quick reminder that we do archive these sessions, our roundtables and educational or special educational sessions on YouTube. You just go to youtube.com and you can search, you can actually use that link up at the top of the page to access a whole bunch of videos.
Mark, we did a help session last Saturday to correlate with our Getting Started series, which you can see down there in 3 parts with the Mackinac Bridge as the background for the opening slide. And we're not posting those help sessions on YouTube for 2 reasons. First of all, we just don't think that our audience would be that comfortable with their names being divulged and with us talking about personal questions on a posted YouTube channel. So we're not doing it that way. And then the whole idea of an open mic is that it's a question answer for the time that you're talking about, and we're not quite sure that there has a lot of shelf life to it. When you ask a question about today and then you try to look at the answer to that question 2 months from now. So we're not going to post those things, but I've received lots of questions about how you use the portfolio creator in the SSG Plus, and I will draw your attention to that Getting Started Part 3 class. And that goes step by step by step into how you create a portfolio in SSG Plus. If that's what your question is, I would urge you to just review that class real quickly. You can fast forward and speed through the parts you already know about, and then slow down and look at the parts that you're having trouble with. But that's the class where you'll get step-by-step instructions on creating a portfolio.
All right, and just fair warning, if your name's Kevin or Jennifer, we might capture a little bit for a short to be published on the page, especially if it's funny or no, I'm just kidding. No, I'm really not. I probably would do that. This session, because it was the day before Easter, has been postponed. It will likely happen in early May, probably May 10th, but we'll keep you posted on that. But it has been rescheduled, or it is being rescheduled if you're in the area. And I'll just leave us with look, they don't even have their seatbelts on.
They don't even have seatbelts.
Talk about times have changed. And look at that tray that she's passing out. Those aren't peanuts.
Yeah, and check out the leg room too.
Yeah, interesting. And people aren't wearing their pajamas.
And look
All
how
right.
wide the seats are.
I
And
know
they
it.
have their shoes on. Yeah, all of them are wearing shoes.
Just an amazing change. Is this what you're flying to Canada, Kim? Your
Well,
upcoming
because
flight?
of the tariffs that are going on, it's finding a flight to where I was going is getting to playing hide and seek because they've canceled a whole bunch of flights.
Yeah, you might want to, pack a couple extra things in case they won't let you out or in. I mean, interesting situation.
I have understand that going by airplane is much easier than driving across.
That I've heard that. Good
The
stuff.
Kim, the delays at the border right now are tremendous,
Yeah.
especially the delays coming back into the U.S. The Canadians are not delaying nearly as much as getting back into the U.S. is happening right now. So you might do much better flying, and you do know that you need one of those new licenses if you're not going to bring a passport, don't you?
I do, and actually, on Valentine's Day, my passport expired, and I went, ooh! So I already have it replaced.
Good.
Good
The
stuff.
passport's the easiest thing to use, by the way.
Yeah.
All right. So with that, anything else in the hopper, or should we say everybody get out there and let us know if you run into any incredible opportunities during this time of intense market fluctuation?
I think we should say au revoir and hope to see you next week. And we hope to be able to report a little bit better market coming in the next 5 days.
All right. Everybody take care.
Bye-bye, everybody.
Bye-bye.